ahead and start everything off. Everybody, I want to welcome you. I want to thank you for coming. My name is Jacob. I'm the social media manager for Gordon Law Group. So if you've ever had any interaction with on Twitter with the page, then you've probably interacted with me at some point. But today we're doing something pretty interesting, coming together with the crypto tax community here, and we're answering crypto tax questions. Now, during this entire show, I encourage everybody who is listening to share this with others, because there's nothing better than free crypto tax information. And we have people who are in the crypto tax space who know what they're talking about. And this is, a very, very valuable resource. So if you want to share this, retweet it, let other people know, send them a message, like it as well. Put as many like emojis, clap hands, hearts in the space as you can. And towards the end of the space, I will be letting people come in one by one. Specific crypto tax question, I'll let you come up to the stage and speak. Also, if you're a little shy and you don't really want to speak, send a message. I have an eye on all the messages, and hopefully we can get to your question. Now, the way that I'm going to do this is a little interesting, a little bit different than what I've done in the past. So we're going to go through 3 rounds of questions. Now, everybody's going to get a question, pretty much. So my first round of questions will be easy. They're, pretty common ones that we see, very often. To all my speakers, if you can give us as much detail about each question as possible. I made sure I picked ones that weren't like simply yes and no. And then we'll go on to a second round of questions. So each speaker will have a few more questions they need to answer. These ones I consider a little bit more complex. And then we have a third and final round where I'm going to kind of like disband order. It's going to be kind of like a grab off. Whoever wants to get it can get it. Whoever wants to add on as well. If you have anything you want to add on to any of these questions, go ahead. But the third round is like specific questions that are a little bit harder and ones that I've pulled from various places on the internet. So whether it's Reddit, Twitter, anything, Facebook that I could find, I found these specific questions. So without further ado, I'll let all of my speakers kind of introduce themselves. I have an order that I'm going to be doing the questions in, and basically my order is going to be accounting first. So I'm guessing that David is behind the accounting account. And but if you want to give yourself a quick intro.
Hey, thank you so much for having us. Really appreciate it. As you just mentioned, my name is David Canedo. I'm the head of taxes and the head of tax product at Accounting, U.S. licensed CPA. Happy to be here today and collaborating with everyone. Since, as we all know, the crypto industry is lagged from. We still need a lot of more clear regulation. There's a lot of issues that I'm sure a lot of people are facing. So, really excited to be here today.
Thank you, David. Next on my roster, we have Crypto Tax Girl. Go ahead and give yourself an intro.
Hi, everyone. Okay, great. Yeah, I have been in the crypto tax space since 2017. I'm a CPA, and our firm specializes mostly in individual taxes, and we help people calculate their crypto gain and loss report, calculate their crypto income, and then we can also file your tax return. And then we provide like crypto tax consultations. We have a crypto tax course if you want to just do it yourself instead. And yeah, we're just like ins with crypto. It's what we do all day, every day, and what we've done for like the last 5 years. So excited to chat. I always love chatting with other experts too, since it's such like a gray area with a lot of crypto stuff. It's fun to always hear like how other people are handling stuff and just have conversations that are a little more forward thinking than the IRS at this point. So excited to chat with everyone. Thanks for having me.
Thank you so much. And like I said, I'm going to keep repeating it throughout the show. This is very valuable information. It's great to have it for free. Share it with others. Get as many people in here as you can. Now, next up on my roster, I have Jordan. Go ahead, give yourself a quick intro.
Hey guys, Jordan here, CPA and attorney specializing in the digital asset space around the same time as the Crypto Tax Girl 2017. Realized that there were people that were going to need help figuring out what to do with their crypto earnings from a tax perspective, because I needed to figure out what to do around that time. And so ever since then, we've just built out the firm on the CPA side, helping people reconcile their data, figuring out what they owe from a gain and loss perspective, from a yield perspective, and then more recently, NFTs, of course. And that kind of grew into helping enterprises account for their activity. So not just individual focus, but also businesses as well. And that's more on the accounting / CPA side. On the legal side, we do a lot of the similar sort of work, but also represent some people with IRS issues, tax matters, do some tax planning, structuring when we can, and try to make sure that the filing process for everybody, whether it's on the CPA or legal side, is as smooth as it can possibly be, because we know people get a little bit anxious when dealing with things they don't know how to do themselves when we're talking about crypto tax reconciliation. So the people in this room are great. Laura is great, Andrew's great, Gordon Law Firm's amazing, Accointing's a great software. So like it's been said, there's some good tax alpha. You can get some information just from hearing what they have to say, and hopefully I can add a little bit of value as well. And we can get this tax season completed with smooth sailing.
All right. And last but not least, Andrew Gordon. Go ahead, give yourself an introduction.
Thank you very much, Jacob. Hello, everyone. My name is Andrew Gordon. I'm an attorney and also a CPA. I've been working in crypto tax since 2014, and like many of the speakers up here today, my firm helps crypto tax investors and traders report all of their crypto activity on their tax returns. But we also represent clients in audits and criminal investigations. So we're very versed with how to address things when things go wrong or not as well as we had hoped. I would say, though, statistically, it's not our clients that are being audited. So it's instead people coming to us generally being audited. But we do have a lot of experience in that side of things as well. So very excited to be here today. While I do a lot of Twitter spaces, this is, I think, the first time that there's such a broad group of speakers that all work in the crypto tax industry. Usually it's just myself and maybe one other. But today we've got various, myself, Laura, Jordan, David. So a lot of great minds, and I'm very excited to see what everyone thinks about all the issues that we're going to talk about today.
Thank you, Andrew. And as a reminder, everybody, make sure you are sharing this with people. Make sure you are retweeting. Make sure you're showing love. Make sure that you're asking questions as well. Like I said, towards the end, we will be getting through some of your questions if you want to come up and speak. I also have the DMs are open, so if you are a little bit hesitant, shoot us a DM. We can read them at the end as well. So kicking off my first round of questions, these ones are a little bit easier, kind of like I said earlier, but I'm going to start with David. Can you break down, first of all, some of the most common taxable crypto events for us?
Yeah, sure thing. I really think we wanted to start off with the easiest question. I think most of us, pretty much everybody who's provided services to any clients holding crypto, we're very familiar. A lot of clients having the common misconception that generally, they think that oftentimes if you buy and sell, the only taxable event is when you convert into or out of fiat. In this case, obviously, U.S. dollars for any taxpayers. Obviously, that's not the reality. And, based on the current guidance, every single time you trade one crypto for another, that's a taxable event. Where I see a lot of people getting into trouble is people are holding a bag of whatever it is, Dogecoin, whatever it goes, does the 100x, 10x, whatever it is, they make a trade into USDT or perhaps Ethereum or something that's, also subject to market changes. Set aside money for the taxes, and then they come into a bad situation where the crypto market drops 90%. They had a gain earlier in the year. They never had another loss offsetting that. And now you're in a bad situation because you don't have the economic means to pay for that. Generally, that's the first thing that I try to tell any clients, anybody that I've worked with, just be cognizant that every single time you trade, it's a taxable event. Within that, there's a few other types of trades that I'd be interested to get others' opinions on. Wrap tokens, trading ETH for wrapped Ethereum. Is that a taxable event? Yes or no? If I'm looking at the guidance so far based on conservative approach, I'd say yes. We don't have the really full guidance on that. Really, other types of liquidity pool contracts, other things that we don't have full guidance on. So I think that's probably for me one of the most important things to really get a grasp on, what's a taxable event when you're trading in and out of coins or different contracts.
Just a few of the common taxable crypto events. Any of my speakers, if you have anything that you want to add on to any of these other questions, feel free, kind of like popcorning, like in elementary school, if anybody is familiar with that. Question number 2, I'm going to kick it to Laura. What are some common non-taxable events?
All right, so some common non-taxable events would be transferring from one exchange or wallet to another. So if you're holding something on, let's say like Coinbase, and you transfer it to your ledger, that is not a tax event. Another one that wouldn't be taxable is buying cryptocurrency with fiat. So if you go and buy $10,000 of Bitcoin tomorrow, that's not taxable. It doesn't need to be reported on your tax return. And the last one that is coming to mind right now is loaning. So if you put up crypto as collateral for a loan, assuming you let's say you put up 5 Bitcoin, then you take out like a USDC loan against that. Each with the USDC, you're paying interest throughout the life of the loan, and then you pay back the loan and you get your 5 Bitcoin back, as long as you're receiving back the same token that you gave originally. So if you give up Bitcoin as your collateral and you get back Bitcoin, that's not taxable. But if you like put up Bitcoin and then you get back the same amount in, or if like the amount of Bitcoin changes, let's say you put up 5 Bitcoin, but the loan instead is based on D value, not on Bitcoin value, and instead you get back like only 3 Bitcoin, or you get back 7. All be taxable events, but those usually are how loans are structured. Usually it's just you put up your 5 Bitcoin, you go through the life of the loan, and you get it back. And as long as you don't get liquidated and you receive it back, that is not taxable either. So those are the main ones that came to mind right now. If anyone else can think of one I'm missing, let me know.
Anybody else have any others? Otherwise, I'm going to move on to my next question. All right, I'm going to pass it to Jordan. I just got scammed out of all of my crypto. Can I report those losses on my taxes?
Great question. Answer on our end is it varies on the type and the way that this occurred. At least that's the approach that we take. For pure thefts or scams, it's very difficult to actually write these losses off currently, the way that the tax code is structured. However, sometimes people make the argument that the way the scam occurred, I sent money to somebody on an exchange that maybe didn't exist. Maybe they thought it existed, but it was a scam. Is this something where I entered into a transaction for the purpose of executing a profit and I received zero something in return? Maybe there's some leeway there. If it's something where I clicked the fraudulent link and my wallet was drained, is that something that can be deducted? Most likely, honestly, there's not that big of a case to take like a theft loss deduction. So I would say personally, the scam, or quote unquote scam, the way that the scam occurs will dictate what you can do from a tax perspective. We've seen so many different fraudulent things occur over the past few years, especially now. I guess you can call some of these centralized exchange and centralized custodians that had these lending platforms quote unquote scams or some fraudulent activity as well. That's a whole different can of worms, I would say, where it's more of a we got to wait and see what happens with those bankruptcy proceedings. But in terms of what can you do from like a theft loss it's very, at least difficult to assess that without seeing the actual flow of what transpired. But the best case that somebody could have would be in a sense where they made an investment that they were scammed, right? And they could write that off as not a worthless investment, but something that they entered into for the purpose of generating profit, and that actually ended up being nothing for them. It was a complete total loss. Whatever maybe their basis was investment can be drawn down, but the scams are getting more. I hate to say this, but the scams are getting more efficient, and to be able to have an ability to write some of these things off from a tax perspective would be great. But when the tax code changed under Trump's administration, the TCJA, with the ability to not maybe write off some of those theft/casualty losses, it's difficult depending on the flow of what transpired. I'd be curious to hear what other people and other tax professionals do in this situation. We always try to find a way to make these losses deductible. But I think it does depend on where the theft came from. The theft comes in so many different shapes and forms. It's not just exchanges. It's not just people stealing maybe like something from somebody with software. Or it's not just somebody talking to someone on WhatsApp and getting getting trust from somebody and having them send funds to their, I don't know, wherever they're sending funds to different wallet addresses. But it's a difficult situation, and most of the time no, but sometimes yes. That's my approach on some of these scams. Just depends on what happened.
So I'll jump in and give some of my thoughts. And Jordan, thank you very much for that. I agree with nearly everything that you said. Back a couple of years ago, this was a much easier conversation. Prior to 2018, there was the ability to take an itemized deduction for casualty or theft losses. So if someone stole from you, they could have stolen your bike, they could have stolen your crypto, whatever it was, you used to be able to take a deduction on your personal return. After 2018, the law changed. And at that time, the only way to take a casualty or a loss or a theft deduction was if it occurred in a federally declared disaster. To have that occur, and also crypto, you're basically talking about a hurricane occurring and at that same time you were scammed by someone locally. So it just doesn't happen. So in nearly all situations, we don't see a way to claim a theft or a casualty deduction. It just doesn't exist anymore after 2018. So instead, we have to look to other areas of the tax code. And the tax code does provide to take a worthless investment loss. However, this section of the tax code, our review of it, is that it generally applies to securities. And that's where things become kind of difficult. And so if we're taking the position that this crypto is now worthless and therefore we should take a loss, we'd be considering it a security. Yet 99% of the time, we try to argue that the security context of the tax law doesn't apply to crypto. Things like wash sales, for instance. So no, it doesn't apply. So it would be inconsistent in our view to then say, well, now we're going to use this section that applies to securities in order to take the loss. In this context, I would note that the loss would be a capital loss. It's basically treated as sold for zero, and then you get a capital loss for whatever your cost basis was. And in some situations, we do think that this is a viable argument. So Jordan, to your point, it really depends on the facts. But in many, we view it as too aggressive. So it really does depend. Hopefully, in light of some of these new exchange closures, FTX, Celsius, and the list goes on, Congress will have some new laws that will allow people to take these deductions. But as of now, it's kind of a difficult spot. So curious what everyone else thinks.
If I may jump in, I 100% agree with everything you said. And I think something that is difficult, I mean, you hit it right in the head about, in some ways we want to take it as, okay, digital assets are not securities, but in other ways we want to take the stance that they are. Obviously, we're seeing a lot of, the SEC, the CFTC, they're still trying to decide who's going to have regulation over what. From the latest rumblings, it seems like maybe everything, not in Bitcoin, could be a security, TBD. So I think a lot of this is really going to unravel throughout really the next few months as we see a lot of the regulators actually kick into overdrive with, the FTX collapse and a lot of these regulatory issues that we have. With that, to me, the one part that is easy with any type of losses, generally, I'm thinking back to the Squid Games token. Somebody buys a coin, there's low liquidity, you get stuck with a coin. That's a little bit easier because generally, from my perspective, you can still have a taxable event. You can get rid of the coin. There's platforms that you can burn the coin to. You can get rid of it. You can do an exchange and dispose of it. Even if there's liquidity, generally ways to have the disposal. But as you said, difficulty then becomes when you start to get into issues like FTX, like BlockFi, where you don't actually have a disposal event and you want to argue something else, stealing. Somebody steals your keys, you lose your hard drive that had your private keys or something. Those are very difficult conversations. And I know for me, if I was working with clients, it'd be a one-for-one. It would be a one-for-one conversation with each and every client, and depending on their risk tolerance, and potentially even including a Form 8275R, depending on what the situation is. But yeah, just my 2 cents on that.
Okay, and I'll jump in here. I don't really have much more else to add besides what everyone else said, but yeah, I always try and make the best situation for the client whenever I can. And so if there is an opportunity, even if it might be like a little bit more aggressive, but there is enough facts and circumstances in the case where we think, okay, this could be considered, like Andrew said, that worthless investment, and we have let the client know like these are involved, then I'll go ahead and usually we'll take that for the client, but just letting them know that there's a chance it could be disallowed. And it's just on an individual case by case basis. But usually I look at like, was the negligence based, like was it due to your negligence? And if so, it's most likely considered like a loss and we can't deduct it. But is it more like something where you were trying to invest in a project and the project just, collapsed, or you're trying to, buy this ICO or buy this NFT and the project, like you had done your due diligence and you thought that this was a valid investment, but then it collapsed. In that case, then I think, it could be considered one of these worthless investments. So it is just a case by case basis. And I don't really have much else to add besides what everyone else said. I can just say amen to that.
That was a good topic for me to bring up if everybody had something to say about it. But moving on, only because for time's sake, final question, Andrew. Okay, this is one of the most common ones that we've been seeing. Can I claim my FTX or Celsius losses on my taxes?
Good question. I'm sure many listeners out there are wondering the same. It's really unfortunate what has happened in the last year with FTX, Celsius, BlockFi, and other exchanges as well. And while many people have had their crypto holdings locked as part of bankruptcy, and many of us consider that really lost and gone and don't have much expectation of it coming back, under the tax code in general, in order to take a claim for this type of loss, the loss needs to be complete and it needs to be known. And in our view, while the bankruptcy is ongoing, these have yet to occur. We don't know, for instance, if there's going to be a partial recovery. In fact, we hope, and many people believe, that there will be some recovery of in part of your holdings. And so if you take a complete loss now, and then later on you get a recovery, it may be an even more negative tax situation, because then you might have to report that recovery as income. So for most people, and again, it's case by case basis, it makes sense to wait and see. That's at least what we're suggesting to our clients until that bankruptcy is resolved, until the resolution is known. And we also think that this is consistent with the tax code and how other events have happened. That said, and as I mentioned before, crossing my fingers that Congress or the government makes some changes. Previously, they did. After the Madoff Ponzi scheme, the tax code was loosened a little bit and allowed for Ponzi scheme deductions. And so even in the Celsius and FTX world, there is still the ability to take a Ponzi deduction if they become deemed Ponzi, but we also don't think we're there either, unfortunately. But what we saw is Congress made an exception in the past, carved out this Ponzi deduction or Ponzi loss. And in reflecting on FTX, I believe the news has said that that was even larger than Madoff. So maybe it makes sense for someone to step in and loosen the laws to allow these deductions. But at least as of now, what we're generally suggesting is wait and see. It's just too soon. Years ago, you may recall Mt. Gox was hacked. It was in Japan. They're hacked. They went through bankruptcy. But most people that had deposits have recovered in part, or some even in full, their holdings. So it's possible. It often takes years, but it's possible. So yeah, I'm curious what everyone else thinks.
I'll just add to Andrew with the wait and see too, especially for 2022, which is where all these losses occurred. Most of my clients are in a loss position already. And if you're not familiar with how capital losses work, you're only able to take a net loss of $3,000 per year. And most of my clients have already exceeded that for 2022. And so taking a capital loss on this worthless investment and taking a more aggressive position isn't going to change your total tax bill at all for 2022. So you as well just wait. And then, once we're a year removed from the situation or 2 years removed from the situation, there is more like argument there as well, and like more facts and different evidence, leaning more towards your way if you were to take one of these more, undetermined, maybe a little more aggressive positions. So if you already have a loss for 2022, like most people, I agree with the wait and see approach.
Laura, thank you for bringing that up, because 100% relevant on your tax situation. As you said, if somebody already has an overall loss, it doesn't make any sense to get more aggressive just to try to make that loss bigger, just to get a bigger carryover. With that, I'm curious to hear your guys' perspective, because for me, anybody that I work with, my own personal return, I'm just going to automatically extend my return. Why? Because in the off chance that we get more guidance between now and the extended deadline of, I believe it's October 17th this year, to me, I don't see any reason to not extend. Is this something you guys are recommending, or what do you guys think?
Yeah, I have been recommending the extension as well to my clients. Because then again, even if we're 6 months more removed from this, especially ones who maybe aren't in a loss and want to maybe take this position, I am recommending the extension. The only downside, to answer your question would be that if maybe not from crypto, but another business or some other sort of income item on their tax return, they are expecting to owe the IRS, they would have to make sure they make that payment by April 15th. Or let's say they have a huge amount of crypto income and they're hoping on this loss that they can take, and let's say something comes out and they're not able to take it, you'll then owe the tax plus the interest and penalties between April and October. So there is a slight risk there. To mitigate it, you could just prepay the tax in the worst case scenario that it doesn't happen, and then if you are able to take that loss, you'll end up getting a refund. But again, like a lot of people aren't super liquid right now if they have a lot of their holdings on and they're tied up in Celsius or BlockFi. So there are the different things to think through when it comes to filing the extension. But if you are able to file an extension and you don't expect to owe, then definitely I would recommend doing that so that we can wait and see if we are going to get more guidance.
Yeah, I would just add one thing. Definitely, if you're going to extend, just like Laura was saying, at least pro forma, that reconciliation, get something on file where you can get an understanding of what your exposure would have been. Maybe you did actually have gains in 22. I know it could be rare, but a lot of people in the NFT space were still making money in 2022, and some traders that took advantage of the downswings also were making money in 2022. So if that's your case, obviously get something on a return and get that reconciliation at least pro forma so you can understand your exposure, because you don't want all these interest and penalties accrued, just like Laura was saying. But to be honest, with every single client that we have that had Celsius, Phi, Voyager, FTX exposure, we've been advocating and kind of pleading with them, even if they had never filed an extension before, which most people at our firm do, but even if they had never filed an extension before, kind of just, if we can, take that wait and see approach, get all the information that we can, just like Andrew was saying, because you don't want to make a determination or make a decision or be aggressive and take a loss or do something here and then ultimately get guidance, which probably will be coming from the IRS. So the first step would still be to don't just push it off, get some work done, get an understanding of where you stand from a tax perspective. At least, if you have a lot of on-chain activity, you can get that stuff done. If you're missing some of the centralized exchange data because you can't access it, which you can for most of these places, so that shouldn't be an issue, at least you can understand where you stand. You don't have to necessarily file the return, get the extension filed so you don't have that late filing penalty, obviously, but it's, I believe, the safest approach for now. And I've been highly advocating for that, and I think most people have been as well.
All right, and that has been my first round of questions. Thank you, everyone. Thank you. I'm going to move on to my second, however you want to deter them if you think they're harder or not. But, David, kicking it back to you again, can you explain to me if airdrops are taxable?
Sure. The long and short of it is that yes, they are taxable based on the current guidance that we have. Really, anytime that you get any type of income, whether it's an airdrop, hard fork, really any new units from staking, mining, all this is generally taxable. The IRS specifically addressed airdrops a couple of years ago. I forget the name of the notice. It was 2019. I can't remember specifically, but anyway, basically they addressed airdrops and hard forks in this notice, basically saying that if you get an airdrop following a hard fork, which wasn't technically accurate, has been corrected since it is a taxable event. Now, usually the bigger issue that I see with this is people that say, well, I have all these different airdrops of scam coins or these, coins that are very that have no liquidity, they're worthless. Usually, to me, that's not that big of a deal because, from my perspective, generally, if you're getting an airdrop of anything valuable, probably you will claim it on your return. You will claim the income and take the basis. You will take the coins. If you're getting an airdrop of a scam coin, something has no liquidity, it's probably going to have zero to no value. So to me, that's not that difficult of a topic, although it is a little bit difficult when you do see, especially people getting in NFTs, and oftentimes you log into your account and you see all the number of airdrops that you have. It can be overwhelming to kind of deal with them.
Awesome. Now I'm going to pass it over to Laura. Could you please explain, and somebody did actually DM us a question super quick about this, HIFO, FIFO, and LIFO?
Explain what they are. Yeah, so HIFO is highest. These are all different accounting methods that you can use when you're calculating your crypto gains and losses, and they are all acceptable. So the IRS, the default is FIFO, which is first in, first out, meaning you always sell your oldest coin first, and everything gets put into a pool, but you always sell your oldest one first. But the IRS says that you can use specific identification method, which all of the ones that you mentioned are forms of specifically identifying your tokens, I guess, in the pools and lots that you're going to put them in when you sell. So I think you said the first one was HIFO, highest and first out. So this would mean that we're always going to sell the one with the highest cost basis, meaning that you're going to try and reduce your total gains or increase your losses by doing this. So a lot of people are choosing to do this, in 2022 when they might not have a lot of cash on hand. They know they were in a loss position, so they're trying to decrease their gains or increase their losses. So that's, but also I always recommend to my clients that you might want to look at the long-term perspective, because even if this year you might end up paying less taxes now, you're deferring, kind of kicking the can down the road. And now next year you're going to be left with all the lower lots. And so next year, let's say then you go and sell some crypto that you think break even on, you might actually have a really huge gain because you only have the low cost basis lots left. So that's how HIFO works. And sorry, what were the other two you mentioned? HIFO?
LIFO and FIFO.
Oh, okay. So I already explained FIFO, first in, first out. So LIFO is just the opposite of that. That's last in, first out. So that would be where you always sell your most recent one. And so if you're buying and selling a lot, this can kind of also reduce your gains and losses because it's pulling something we bought like a week or a month ago or even a day ago. So usually there hasn't been a huge gain or loss on that coin. Of course, there can be. Crypto's so volatile, but overall, compared to doing your oldest one with five, there's not as much volatility if it's just within a week or a month or your most recent one. But the downside to LIFO is that it's really hard to qualify for those long-term capital gains because it's always going to pull the most recent one. So let's say, you had some ETH that is almost at a year, you're just about to qualify for your mark and you go and buy some new ETH, and then 2 weeks later you go and sell it, it's going to pull the newest one. It's not going to pull the old one. And so it's really hard to qualify for those long-term capital gains. And those long-term capital gains can really help reduce your total overall tax bill, especially if you're in a higher bracket, it can be taxed at like half the amount of tax as a short-term capital gain. And if you're not familiar with those words, a short-term capital gain is crypto that you've held for less than a year. And then long-term capital gain applies to crypto that you've held for more than a year. So overall, I usually recommend FIFO or one of these other specific identification methods that kind of looks at more of the long-term perspective. On the tax software I use, there's one called Opti where it like optimizes for long-term capital gains and like reducing tax in the current year. So it's always, interesting to play around with it and see how it's going to impact your current bill. But that's what those all mean.
If you don't mind, I have a follow-up / question. So that was a great explanation. I think that was really, really clear, and I think that gives a great understanding for everyone that wasn't understanding what those methods are. The only thing I'd add is because I just get this question a lot. Can I jump back and forth from these cost allocation methods year over year? And I have a question for everyone on the panel that kind of is, this is the segue to that question, but the answer that we always give is not really, because what's going to happen is you might be double dipping in basis, you might be double dipping in that holding pattern, so you can't really go from FIFO to LIFO to LIFO to HIFO to HIFO to FIFO year over year. If somebody completely rebalances their portfolio, meaning like they've liquidated everything and they're starting with just USD from scratch, then maybe that's a feasible thing to do, but at least that's a position that we take. I get that question a lot. I'm sure everyone on this gets that question as well, so I just want to bring it to the audience's attention. The question that I have, and I don't mean to hijack the questions, but are we, knowing that we're going to be hopefully soon maybe seeing these 1099s, maybe not 2024, maybe it's 2025, are we taking the approach at your firms that we're looking at everything from like a universal accounting method where everything is just one large wallet, or are we kind of segregating things, different tax law and different wallets and different exchanges? Because if that's the case, that's how we do it, there is the ability to go with different tranches of assets per exchange and per wallet. And I don't know if that's something that would be addressed on some type of medium, but it's an interesting thought, because I think a lot of crypto tax softwares that users will be using before they maybe reach out to a professional give that optionality to maybe do everything as separate sort of tax lots, or to treat it as like a universal entire portfolio, looking at it from a standpoint, which might not be accurate, and in the case of an audit could lead to errors and material changes.
So I think that's an awesome question, and it's probably one of the areas of crypto tax law that remains the most unsettled. And from our experience, even the IRS hasn't quite settled these questions. We've got a couple audits ongoing right now where LIFO was selected, and the IRS, LIFO at a universal basis was selected across all exchanges. And the IRS is saying that no, that is not sufficient to meet the requirements of specific identification, and that the IRS FAQs, the IRS guidance, allows two options: FIFO or specific identification. LIFO, HIFO, any of those may be a subset, maybe a type of specific identification, but in order to meet specific identification, certain requirements must be met. We as a firm generally do not apply HIFO or LIFO on a universal basis. Instead, in certain situations, we apply it by exchange. We specifically identify transactions, and for instance, you've got a wallet that you buy Bitcoin, deposit it directly into that wallet, and then you have another wallet that has Bitcoin that you bought a year ago, and another wallet that has Bitcoin that you bought 2 years ago, and you take the Bitcoin out of the most recent wallet and sell that. We feel that is a specific identification. We can show that, treat that as sold. But I would agree, Jordan, that there are concerns with applying it on a universal basis. Many of the tax softwares out there do that. They allow you to just click HIFO, LIFO, whatever, and then it applies to everything. We have concerns about that. And also what we've seen is some software has moved away from that. TaxBit, for instance, is now doing it on a per exchange basis. And that seems to be consistent with what the exchanges will eventually be reporting. Coinbase, for instance, seems that they're going to be reporting their activity on a HIFO basis. So it's a complex question. It's a great one, Jordan. Thanks for bringing it up. But yeah, I think that there's unfortunately not a lot of clarity, and we would generally suggest using FIFO unless we can do things in a more specific way by lot or by exchange.
That's interesting, Andrew. Thanks for sharing all that. We actually, I mean, and again, who knows what auditors you end up getting dealt with, or even if we're in the same like jurisdiction, our clients. But we had a client who filed FIFO, wanted to switch to LIFO, and we filed it, and he received like a $500,000 refund. It was a really large swing, and he did get an audit notice where they just said we want some more info, and so I sent in explaining why there was the swing because they switched accounting methods, and they were fine with it and issued the refund. So that's interesting to hear, and it was a universal LIFO. So I'm interested that on your end you got pushback, and on my end it was no problem. I mean, I guess a little bit of a problem because they pushed back on it a little bit, but once I explained the situation, and it was both. He got audited in California and federal, and on both I gave the same explanation, and it was fine. So that is interesting. We have been doing the universal and do allow like the other specific identification methods, which is maybe a little less conservative than what Andrew described. And we just thought when the IRS does issue those 1099s, they'll most likely check box B on the 1099B. They won't check box A, I don't think. So I'm guessing box B, which would allow you to adjust the cost basis if assuming that it's in a universal pool. And who knows if that'll be like you're able to do that year to year, but I'm guessing at least the years that would be necessary. But yeah, interesting to hear that you've had like different experiences. So again, this is all like such a slight gray area at this point. So I love having these convos about it.
Yes, and if I may, I think it's one of the great things about getting getting the four of us together here just to share experience, because I mean, it's not surprising that it depends 100% of the auditor who is, who's looking at this stuff, who's working with you. As we know, the IRS is, even with additional funding and additional auditors, they're still going to be underwater, especially to really deep dive into a lot of the reporting and from these exchanges that the information reporting requirements are not fully there yet, since the infrastructure bill is not in place yet. I generally, looking at the FAQs from the IRS, I mean, clearly they say, specific identification is the best. Outside of that, you should use FIFO. However, our stance, we have allowed people to use FIFO, LIFO, or HIFO. Two reasons. Number one, we have other jurisdictions too that we cover, although I can tell you 95% of our users use FIFO. And basically considering every single wallet separately, which is what I would recommend from a more conservative standpoint. However, we do allow the other methods, since if I'm looking at, if you read between the lines in the IRS's FAQs, the requirements for specific ID, they don't fully say that you got to identify it right before. So it's a little bit of, it's not fully clear. So you can kind of make the argument that LIFO or HIFO would suffice. Now with that, if I'm looking at which way everything is headed, yes, I would assume that 100% you're going to have to treat every single wallet separately going forward, especially with 1099s. I know for this year, a couple of exchanges, I can think BlockFi, obviously with their issues, Uphold, a couple of them are issuing 1099Bs. So we're starting to see the issue in that, taxpayers, customers, they have a 1099B, they have the data here, but they have this report. The data in the 1099B is not complete, so now you got to reconcile the reports. So that honestly is my concern heading into the next couple of years, especially as the 1099Bs or 1099DAs get started in the digital asset space, really how the information, how taxpayers are going to be able to reconcile year over year and make sure that you're not double reporting any income. But for now, I mean, I can't disagree. I'd say the most conservative way is saying that every single wallet is going to be independent of another. Again, if you buy a Bitcoin on Coinbase and you sell it on Binance, but there are two different buys, can you make the argument that this one is that? We'll have to see. I find that I have to guess, just my assumption is probably going to be difficult that the IRS is going to head into that direction, but I guess my guess is this is good as anyone's.
For the sake of time, like I have like maybe 50 questions prepped. There's no way we're going to get through all of them. I want to see if anybody has questions now. Go ahead, request to speak. we'll try to get through them like as soon as possible. I know everybody has their own schedules. This is like our busiest time. So if anybody has any questions, I do have one request right now, and that is from Tout. Welcome, Tout. Any questions? Go ahead, Tout.
Hey, thanks for bringing me up, Gordon. Appreciate you guys taking your time to help us out with these questions. I know this stuff is like super complicated, especially for me. I just have one or two questions. I have a million questions, but I'm not gonna take up like you guys will never leave if I end up asking every question I have. But one of my main questions that I've been struggling to kind of find an answer for is regarding ApeCoin. ApeCoin, I'm not sure how familiar you guys are with it, but I don't know how to treat it from a tax perspective because it wasn't technically airdropped. It was claimed. So every ape, for example, so my mutant ape, I was able to claim 2,042 ape tokens, and I paid a gas fee, which is like very marginal, like around $15, $20, something like that, to claim my ape token. Now, do I have a tax implication for the value of the ape coin when I received it, or does the tax event take place when I sell that ape coin? I just haven't been able to find a clear answer. Or is there a double tax event? Do I have to pay taxes on the value of it when I receive it and when I sell it? I don't know. Does anybody have any information on that?
I think we all got you on that one. The question is, who wants to answer that? Jordan, you got it?
You can go for it because I actually have to jump off here in 4 minutes, and I don't think I can give a 4-minute answer on this one. But go for it, Andrew.
You want to give it a 2-minute answer? And then you can jump? It's your
yeah,
call.
sure. I'll give it a 2-minute answer. So we'll see if I can give a 2-minute answer. Basically, what happens in this situation, we've seen a lot of people trying to take the position of what you just said, Tout, right? Where you have, this is like an airdrop, but is it really an airdrop? I've actually executed a transaction to acquire this asset. I have rights to receive it based on my holdings of an ape, of a mutant, of whatever I had in my wallet. And that was like a token that unlocked the key to unlock the door to actually, claim this reward. The real question is, and what we see with the IRS, obviously the airdrop guidance that was mentioned earlier is not really indicative of this because that's a different structure. The guidance was like an airdrop coupled with our hard fork coupled with an airdrop. That's what we initially had. This is more so akin to like the ENS airdrop, but it's still a little bit different, but similar. And basically the answer is there's income there. You have the right to receive this income. You had the ability to claim this asset, and effectively what you have is dominion and control over these funds. There's a value of what the token was worth, theoretically, at the time when you could have claimed that. And when that is there's income. Now, people might take an approach that that's not the case, that, hey, I actually executed this transaction. I paid like $50 for this asset, but this asset was worth $20,000 at the time that I did that. Does that really make sense? People take that position. People also said, hey, I didn't never claim this and I still had my ape, and then I put the ape with the ape coin wrapped into it. There was a right to actually claim this ape coin when I sold the asset. I sold it at a premium. I was holding on to this ape longer than a year. Now can I fold that excess premium that I sold my ape for with the right to still claim the ape token? Can I just claim all of that as capital gain and maybe it's long term? These are like some of the nuanced questions to see. But when we're talking about that ape coin airdrop, at least our approach is that there was income. You did have the ability to claim that asset. If you never claim it, right, if it just sits there and you never claim it, then what happens? Well, that's a whole nother story that maybe Andrew wants to tackle because that's a weird sort of situation. But our approach is that there was income at the time that you had the ability to claim that asset. There were price oracles that we could probably determine what that income value is and or was. And there's definitely a argument, I would say, to claim that it's not income, but the safest approach and the one that's most consistent with anything that I've seen from a guidance perspective would be to treat that as income at the time that you could receive it.
For the sake of time, everybody's time is super, super valuable. I'm going to have to cut it here. Hard stop. Tout, any more questions, you can feel free to DM any of us. We'll get to it as soon as we can. But with taxes comes, a crunch for time. I know everybody is super busy right now. But again, we're going to have to either get all of these folks on again or do another panel, hopefully. I want to thank everybody for being here. So David, Andrew, Laura, Jordan, I really, really appreciate it. If you guys have anything else that you want to say, like within a minute, that would be great. But yeah.
Thank you very much. And I guess in closing, the tax deadline is a little bit over a month away. If you don't think that you'll be able to file on time, file an extension. It's better than doing nothing. So I guess that's my closing tip.
That's a great word of wisdom.
Definitely
Yes.
do that.
Thanks so much for having me. This was really
Yeah.
fun. Thanks, guys.
Thank you, everybody.
And if everybody go ahead and follow everyone, send them a message if you have any type of text questions. Sorry, David, did you want to add anything? I didn't want to cut you off.
No, nothing. Just to reiterate, thank you for having me. Yeah, 100% agree. File an extension wherever possible. Make sure to just get all your data to the best of your ability. And I mean, at the end of the day, just trying your best to report everything correctly. You'll be 95% ahead of the game, really, especially if you work with anybody on this call.
This is all great information. Keep an eye on Gordon Law Group, this specific account, because every week I'm going to be hosting spaces. Next week we're going to be doing NFT spaces. And if I get enough feedback about this particular space, I'll get everybody back again, hopefully before the tax deadline, maybe even after, and we can go through more questions because we only hit such a small amount. But I want to thank everybody again. We will see you next week. we can go through more questions because we only hit such a small amount. But I want to thank everybody again. We will see you next week.